We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
Welcome to Finances, your home for all things financial, investment, money and lifestyle. Hosted and curated by the very talented team of certified financial planners and Burke Financial Partners. So this is a short and sharp episode of Finances. Ben, we've been talking a little bit about topics that we sometimes, complicated topics that we might simplify, or sometimes the opposite, simple topics that we overcomplicate. We're going to talk a little bit about
sequencing risk. Sounds very boring, pretty technical. I think, again, like you just said then, sometimes we probably disregard in our own mind all the strategies we're actually overlaying into someone's situation because we do it so often and so frequently. Probably sometimes got to remind ourselves that these are those little things that we're doing just out of habit. We're not even consciously going, we better protect for sequencing risk. We're just doing it because it's a staple for us, isn't it?
So let's explain sequencing risk.
I thought I'll just read a very short definition of it rather than butcher it myself. So what is sequencing risk? Sequencing risk is the risk that the order and timing of the investment returns are unfavourable, resulting in less money for retirement. Again, so what does that really mean?
Put that in context of a retirement client.
Let's just break it down and say, basically, every year the market has different returns. Sometimes they're good, sometimes they're bad. We know what they are on average, but they're not the average every year. Now, the order in which those returns occur in can be dangerous. So, very simply, you've got $1 million, you retire, and in year 2, the market crashes by 40%. Does that impact the longevity of those funds? It depends. It depends how you set up. It depends what structure you've got. It depends how you derive your income and how it's structured internally. So for a lot of clients, it's just an absolute no-brainer to protect against sequencing risk, which is that you're going to get a bad year early on. So if you have a bad year early on and you're not set up to protect yourself from it, it can take years, maybe even decades off your ability for your funds to meet your needs for the rest of your retirement.
I think I can think of clients that have come to us having been at the
scarred.
At the arse end of poor sequencing risk. Practically, what are the things that we do as financial advisors to manage sequencing risk? And that example you had where 2 years into retirement, market shits itself. How do we make sure that doesn't totally destroy someone's retirement plan and erode their capital irreversibly so that they can't then recover?
There's a couple of different ways we do it. Probably the one that more people have heard of is sort of the bucket approach. So ensuring that we always have a bucket of defensive or cash, term deposit, really safe investments inside of the fund where you could draw down from for a period of time to protect your growth assets. The growth assets being the shares and managed funds, etc., that have actually been impacted by the market. So, again, simple terms, year 2, market crashes. Now, instead of drawing your living expenses, your pension payments across your proportionate portfolio and drawing down those shares at a terrible time, you use the cash protection to fund your needs, retain the shares, and then look to sell out of that later on when it's a more favourable time to do so. So that's probably the really basic option, where we probably layer our protection from sequencing risk, which is to separate capital from income. So if we're going to have a mix of investments, we'll have clear delineation between our shares, our managed funds, our term deposits, our bonds, and our cash. But we also know what income they generate. So if they're generating income, you're only ever living off what income is generated through dividends, interest payments, coupons, distributions, etc. So if you're living off those, then again, you're not selling your capital. Ultimately, it's about not selling at a shit time in really simple terms. Now, again, I won't use a sort of another fund name, but a lot of really simple funds, and if not sort of getting advice around it, they're in just an unitized environment, which means they're in a single.
Geez, you were careful there, not putting anyone in it. Or
no. Well, you can be in any fund and be structured well, and you can be in any fund and structured poorly.
Yes.
So that doesn't matter if you're in XYZ fund or ABC fund. If you've not got the internal part right, then you're going to fall down. So
what would be one of the practical risks? Let's say we're in a unitized fund where everything's bundled. When we're drawing from that, if we haven't managed our income needs correctly, and we're having to sell units to fund.
So you're selling. Like, it doesn't matter what you do. Every time you draw money out of a unitized environment, you are selling something to fund that. So what happens is if you have to sell 100 units, inside of each of those units is basically maybe 70% is share component and 30% is cash or defensive component. So every time you take a payment, take a distribution out for yourself, you're selling down a portion of shares. Can
I give you an example and you tell me whether this sort of fits in? So let's reverse back. This is a hypothetical client. Client's just retired COVID. Let's go back to the global financial crisis. Lasted a lot longer in terms of the downturn. Yep. So there was a more significant period of downturn. The client's retired. They've got all of their money in a balanced index fund, and they haven't left a cash pot to be able to draw pension or income payments from, but they need income. The market's on its way down, so the share market's declining, but they still need their income. So every month when they need their, let's say, $2,000 a month of income payment, what happens?
Well, they're crystallising losses, and they're drawing those depleted units down at a terrible time, aren't they? They're going to have to.
Would that be a good or a bad example of sequencing risk?
It's bad. That's when it really kicks you. So what you've done is, essentially, if the market drops by 50%, you might have, by extension, drawn down the equivalent of 2 years in one of what your actual income needs are, because you're drawing down an asset at its worst time. And then when the market recovers, there's not as much there to recover. So you feel the dip, then you nibble away at it while it's at its worst or on the fall. And then when it starts to recover, there's just not as much skin in the game to actually get the bounce back. Now, if you hold your shares and you've got the buckets and you've got the protection built in from sequencing risk, those shares will fall. Yes, that's what markets do. But you can continue to draw down from your other areas, your cash, defensive, use the income that they're still producing, retain those investments, wait for the market to recover. And ultimately, most of those clients, which we've seen through GFC and more recently the COVID downturn, they actually end up in exactly the same point, if not better, quickly. Whereas other people have made poor decisions or they're poorly structured, they actually never recover. And they're the people that they almost carry that with them for the rest of their life. Like it's a burden.
Yeah. I'm sure we've talked about this, maybe not under this heading or this subset of sequencing risk, but that idea of you do not want to be in a position when you're in retirement or any time where you're forced to a distressed sale of assets that you don't want to sell. And a lot of the work that goes into portfolio management and actually structuring the way your money is invested is to actually protect for future risk. It's not only about where the funds are allocated, it's not just about how much you have in growth or defensive assets, but it's, like you said, how much income are we actually expecting to get? Where is it coming from? Have we been able to proportion off the cash so that we only have to draw on that in times of market downturn? Again, this is one of the examples of giving people a bit of a peek under the hood at what goes into investment management and the thought process around portfolio construction. It's not a simple set and forget, invest and don't worry about it.
Yeah, it's a bit of almost a hygiene thing for us. Like it's just it really is a non-negotiable for those retirees and the ones nearing it. Like, or I almost look at it for that decade prior, starting to provision more cash. I had clients in last night and they're sort of just at 50, looking to retire at 60, access to super. They're a bit more aggressive than they will be when they get to retirement. We just talked about over the next year, if we can, next 10 years, if every year we can bank 1% of what they've got coming through to build up more defensive exposure, by the time they get through to that point at 60 and they turn the tap on, they'll have a whole another 10% banked in the safety net. So then if something happens when they're 61 or 2, they're not going back to work again. Yeah, it's going to be okay. But we've got to start that process. Like for them, it's a decade out. Sometimes it's earlier. It depends. But it's a long-term strategy to build to that position. some people will do it loosely, roughly, and incorrectly. And that's where you've just got to be so careful. It's not, we're probably, again, simplifying it too much in terms of getting it right.
Yeah, finding that balance between simplifying the topic and making sure that it's easily digestible. Again, I know we talk about this ad nauseum, but whenever anyone's thinking about coming up to some of those areas in their life, retirement planning, they've got to make some investment decisions. You really need to give consideration to these things. You really need to put some thought into, or get someone to give you a hand with the thought process around how you manage these kinds of risks. So, how'd we go, Ben? It was under 10 minutes.
Tight. I liked it.
Happy with that?
It was nice little bite size.
All right. We'll see you next week.
Beautiful.
We hope you enjoyed today's episode. If you're keen to understand more about how financial advice could benefit you, follow us on Instagram, Facebook, and Twitter at Burke Britain FP, or Google Burke Britain Financial Partners. Check out our client reviews, testimonials, and make a time to meet one of our certified financial planners by clicking Book Now on our website. Thanks for listening.
Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decision, listeners should consider the appropriateness of any information with regard to their particular objective, financial situation, needs, and seek independent advice from a licensed professional specific to their circumstances.
All right, hit it.
That translates to don't be a moron and act on what some random person says on a podcast. Take personal responsibility, do your homework, ask questions, and speak to an actual human that knows what they're talking about before you do anything. PB Financial Solutions Proprietary Limited, trading as Burke Britain Financial Partners, are authorised representatives of AMP Financial Planning Limited, AFS, licence number 232706.